What exactly is financial crime and why does it matter? This video delves into the intricacies of financial crime and money laundering. Explore how these illegal activities impact the economy and the measures in place to combat them. Financial crime encompasses any illegal conduct involving money or financial services. It includes fraud, money laundering, and terrorist financing. The UK framework is governed by the Financial Services and Markets Act and the Proceeds of Crime Act. The Financial Conduct Authority defines it broadly, covering fraud and market abuse. Understanding these definitions is crucial for compliance. Financial crime manifests in various forms. Money laundering disguises the origin of illicit funds. Terrorist financing supports illegal activities. Bribery and corruption involve undue influence. Fraud and tax evasion undermine economic stability. Sanctions breaches violate financial restrictions. Financial crime has significant economic impacts. Over £100 billion are laundered annually. Fraud alone costs the UK economy over £200 billion. Detection rates are alarmingly low. These crimes fund other serious illegal activities, distorting markets and eroding public trust. Money laundering is the process of making illicit gains appear legitimate. It involves converting crime proceeds into usable assets. Under UK law, it covers cash and other property. This includes shares, digital assets, and luxury goods. Handling your own crime proceeds also constitutes money laundering. Money laundering typically involves 3 stages. Placement is the initial introduction of illicit funds. Layering disguises the funds through complex transactions. Integration reintroduces them into the economy. Some schemes may skip or combine stages, but this model guides enforcement. Placement is the riskiest stage for launderers. It involves physically disposing of cash into the financial system. Techniques include smurfing and using cash-intensive businesses. Purchasing high-value goods with cash is common. Red flags include unexplained large deposits. Layering obscures the origin of illicit funds. It involves complex transactions across jurisdictions. Techniques include wire transfers and shell companies. Trade-based laundering and crypto assets are also used. Red flags involve unusual patterns and high-risk jurisdictions. Integration reintroduces laundered funds into the economy. It allows criminals to spend or invest openly. Techniques include property purchases and business investments. False loans and luxury goods are also common. Red flags include large purchases by overseas entities. In 2021, NatWest was fined for AML failures. The bank failed to monitor a jeweler's accounts. Over £264 million were deposited in cash. This was the first UK bank prosecution under money laundering regulations. It highlights the risks of weak AML controls. The UK imposes financial sanctions to restrict dealings. Breaching sanctions is a strict liability offense. The Office of Financial Sanctions Implementation maintains the list. Firms must screen customers against the live list. Sanctions can freeze assets and prohibit transactions. OFSI implements financial sanctions in the UK. It can impose penalties up to 50% of the breach value. OFSI works with the NCA and FCA on enforcement. Firms must report suspected breaches promptly. OFSI issues licenses for restricted activities. Sanctions breaches have severe consequences. Criminal prosecution can lead to imprisonment. OFSI can impose civil monetary penalties. The FCA can take regulatory actions. Breaches affect both firms and senior managers. The FCA is the UK's financial services regulator. It supervises around 50,000 firms. The FCA's objectives include consumer protection. It also protects the integrity of the financial system. Promoting competition is another key role. The FCA supervises anti-money laundering compliance. It sets rules in the Financial Crime Guide. Firms must maintain effective systems to prevent crime. Senior managers are held accountable. The FCA collaborates with other regulators on cross-border issues. The FCA has extensive enforcement powers. It can impose unlimited financial penalties. Public censure and business restrictions are possible. The FCA can prosecute under money laundering regulations. Individuals face penalties and prohibition orders. Civil sanctions have a lower burden of proof. They are imposed by regulators like the FCA. Criminal sanctions require proof beyond reasonable doubt. They can result in custodial sentences. Both routes can apply to firms and individuals. The JMLSG promotes good practice in AML. It issues guidance approved by HM Treasury. This guidance is not law, but holds privileged status. Courts consider it when assessing compliance. Following JMLSG guidance ensures safer compliance. With this knowledge, you can better navigate the complexities of financial compliance. This is the conclusion of the video. Feel free to send a WhatsApp message to 074843616688 if you need assistance. Our team is here to help. Thank you for your attention, and we'll see you next time.